So you're considering Phoenix, Arizona as the place to buy your next home, but you never actually purchased a home in Phoenix, Arizona. So how do you go about doing that? What is the process? Should you buy cash or should you get financing? What are the things that you need to know to be successful in buying your first house ever, or maybe your first house in the state of Arizona? We're gonna break it all down for you right now in this video. This will be a good one. Stay tuned. But before we break that all down, go check out our Google reviews. Our team, Cook & Associates Real Estate Advisors, has over 430 5-star reviews to check out. We would love to answer any questions you have specifically about your situation. Let's break it down now. We're gonna go deep and we're gonna make sure you know everything that needs to happen. Matter of fact, we're gonna answer probably the top 4 or 5 questions that we get all the time from people who are looking to purchase a house. The question we get all the time, probably the most, is how much cash do I need to actually buy a house? There are a lot of misconceptions out there about that, but the reality, the short answer is 0 up to as much as you want of the purchase price. That's right. And do I get a better deal? Do I have to submit less documentation on my loan if I'm going to actually put down a lot of money, say over 50% of the purchase price, and take a small loan out? And the answer is no, you don't. The underwriter will underwrite that loan the exact same way as if you're borrowing 80% as if you're borrowing 30%. So you don't get a break there, which is a common misconception. But let's go back to the cash thing. I said 0, that's right, to buy a house. Wait, Kelly, you're saying I can buy a house for 0 down out of pocket? Yeah, I am. And here's how we do it. Number 1, there are different types of loans that we're gonna jump into as the next question, because that is one we get quite often as well. But before we go there are loan types that actually will require 0 down because of a bond payment or something else that is paying that down payment for you. But Kelly, do I have closing costs? Yes, that's another question we're gonna address here as the 3rd question in this video. But the answer is you're going to have some closing costs, and there is a way that we do it when we negotiate an offer for a client in which we will get the seller to pay all your closing costs. So therefore, you could literally buy a house with 0 down and 0 closing costs because they're rolled in the loan, or the seller pays them, however you look at it. Which means if you're gonna rent a house, typically you're gonna have to pay a first month's rent and a security deposit or some sort of deposit. So you could literally buy a house, move in for less money out of pocket than you would if you rented a property in certain scenarios. Pretty wild, right? But it's true. So now let's jump over to the second question we get quite often, which are, what are the different loan types out there if I'm going to get financing on a house? Now, contrary to popular belief, there actually are quite a few different loan types out there. And let's start with the first one, which is a down payment assistance loan, otherwise known as DPA. This is the type of loan we just talked about that you could possibly qualify for to put 0 down out of pocket, because a bond program with the County of Maricopa here in the Phoenix area will actually cover that for you. Now, there are some qualifications for that, so we want to check with our lender, because you cannot make over a certain amount of money when it comes to your income. But guys, I'm telling you, this income threshold is actually very high. I think the last time I checked, it's just a little bit over $100,000 a year of income. So it's not like you have to be making a very, very little amount of income to qualify for this loan, which is an awesome thing. Now, there are some conditions that apply to that loan, but we're not gonna get on those on this video. So give us a call at 480-660-5974, and we'll get you in touch with our amazing lender partner who can go over all the details for you on that. Just know that it exists. The second type of loan, as we move up in the amount of down payment that may be required, is going to be a VA loan. That's right, a Veterans Administration. That's what it stands for, but it's a loan specific for veterans that served in our military. So this is an amazing loan because it requires 0 down out of pocket as well. But again, you have to have your eligibility for the VA loan. It's an amazing loan for many reasons that has a lot of perks, backed by HUD, which is a government agency. One of them being the 0 down payment, another one being no mortgage insurance payment that needs to be made, and a third one being that if it doesn't appraise throughout the process of purchasing the house, that you don't lose your earnest deposit. That's pretty cool, amongst others. So give us a call regarding that and we can answer more questions. The next one that is also backed by HUD, the government agency, is FHA, which stands for Federal Housing Authority, which is, again, is a low down payment loan. Now, it's not 0, but it is low. It's currently at 3.5 on the down payment, which is amazing. And it's a little more lenient when it comes to the conditions for the underwriting on this loan when looking at getting approved. So FHA loan could obviously work out very well for a lot of people. Now, there are some minimum standards that these loans require a house to be in. Like, for example, no wires can be hanging out of a ceiling. You have to have a stove that's in working order, things of that nature that they want to have verified when going through the appraisal process and the underwriting process to ensure the house is up to some sort of minimum standards for living conditions. That is an FHA loan. Now, the current loan limit stands for Maricopa County here in Arizona for Phoenix at $530,150. That's right, guys. All of these loans have a loan max limit that cannot go over that amount. So if you're at $530,150, that's your loan amount. Your purchase price can be a little bit above that because you're going to put down 3.5%, making that loan limit not exceed that number. The next loan type is called a conventional loan. This is a loan that's backed typically by Fannie Mae or Freddie Mac, two GSEs, government-sponsored entities that actually buy most of these loans on the secondary market after you fund and close on your loan for your house. These are the most popular and common loans that are out there. Now, the loan limit for a conventional loan in Maricopa County currently stands at $766,550. So it's a bigger loan amount it will allow someone to use if getting a conventional loan. When it comes to down payments for a conventional loan, they start sometimes as low as 3%, but more commonly, they're at 5% down, 10% down, and 20% down. Now let's talk about really quick mortgage insurance premium. That's right, if you put down less than 20% when you buy a home, you're going to have an additional fee that the lender will charge you called mortgage insurance. And that premium, that payment is dependent on how much you put down. So that payment will be a little bit more if you're at 5% down, a little bit less at 10, and then at 20, zero on that mortgage insurance premium. So if your payment ends up being $1,500 a month, let's say, you're going to have potentially a payment of $1,700 a month, hypothetically, because that extra $200 will be your mortgage insurance premium payment that's tacked as part of your total payment if you don't put 20% down. Now, the good news is if you put less than 20% down, you'll have that payment. But as time goes on, you have the opportunity to get a new appraisal. Contact your lender. They will not contact you. They want you to keep paying that additional fee. But if you get to the point where, because of appreciation, your house grows and it's worth up here now, and you pay down your debt and it's down here, and now you're at really 78% is what it gets to loan to value, then you can call them up, get a new appraisal, and get that mortgage insurance wiped off your loan for the remaining time that loan is in play. So that's kind of cool. Just little things that you should know when you're looking to get financing for a property you're buying. Another popular loan type are called jumbo loan types. Jumbo loans are typically bought on the secondary market by these private investors like E-Trade Financial or SunTrust Financial, or these big banking conglomerates that buy this debt as an investment on the back end after you close on your loan. So sometimes jumbo loans could have a different qualifying process than a conventional loan because it may go through more scrutiny due to the fact that it's a much higher dollar amount than a conventional or FHA or VA loan. Now, there are a few more loan types to go. I know it's a lot, but these are more creative type loans. It starts with the first one being a stated income loan. If you are a 1099 independent contractor, you can actually provide all your information, you state your income, and there is a calculation and underwriting process that goes through for that. You also have a bank statement loan. This is somebody who may not file tax returns or haven't filed for a while because maybe they got an extension or it's late or something, and they just want to get qualified not based off their income, but their bank statements. They have a ton of money, they sold a business, they have no more income coming in because they don't work anymore maybe, but they have a ton of money sitting in the bank account. Then a lender will give you a loan based upon that. The last one we'll cover is the DSCR loan. That's right, it's called Debt Service Coverage Ratio loan. And what that loan does is primarily used for a lot of things for investors, but Airbnbs are a great example of where a DSCR loan could be used. For example, if the lender determines that the amount of money cash flow this property will kick off as an investment to the borrower will exceed the monthly payment of the loan, they will grant you the loan without even looking at any of your financial statements, which is pretty cool. But again, you have to demonstrate that it will obviously cover the debt on that property. Okay, now let's go to the third question we get all the time, which are, what are closing costs and how much will they be? Great question. So we're gonna break this down in two different subcategories. The first one's gonna be fees that you pay before you actually get to the closing table and close on your house, and fees that you pay at closing when you actually close on your loan or your house. So we highly recommend that you have an inspection, a general home inspection on your house. In the state of Arizona, these home inspectors are licensed and they do have a governing body that watches over them, so that's good. That's good to have that type of inspector. We have an amazing inspection company that we would love to put in touch with you if you want that referral, but they do the overall basic general home inspection. And now you can go crazy on all kinds of specific inspections, but I would recommend not to worry about that until you get the general home inspection finished. Now, the other inspection you want to have at the same time, in my opinion, is the termite inspection. That's right, guys. In Arizona, we have what are known as subterranean termites. They're not very destructive in a short period of time, but they are very, very prevalent. So it's not really a matter of if you're gonna get them, it's a matter of when. But I had a termite guy a long time ago when I moved down here from the Midwest tell me that, Kelly, it's about a 7-to-1 ratio, meaning for what we're used to in the Midwest and the East Coast, these termites that eat away at the wood and cause extensive damage, what takes them about a year of damage to do takes these subterranean termites in the desert here about 7 years to do. So again, less destructive, but very, very prevalent. So you want to have that inspected and then, of course, treated, negotiated between the buyer and seller when you're looking to buy your house. Now, the general home inspection is going to cost somewhere in the ballpark of, call it $600, plus or minus the size of the house, the amenities it has, like a pool and things of that nature. The general termite inspection is going to be around $60 to $75, somewhere in there for that. So it's very, very important that you get that done. It's well worth the money. The last two inspections I'll touch on really quick are going to be the main sewer line inspection. That's right, guys, this is a no-brainer. This will cost an extra couple $100 typically to have that main sewer line out to the street inspected, but you need to know the condition of what's that in. Why? Primarily because insurance companies, they don't cover the main sewer line from the house to the sidewalk or the street where it taps into the main city sewer line. So you want to have that done to make sure you know what you're getting yourself into, because that is not a cheap fix, let me tell you from experience. So you want to have that done. Tree roots can get in there and all kinds of funky stuff. Now, typically if the house has been built in the last 20 to 30 years, it's not as important. But if you're buying a house that's especially 30 years or older, it is an absolute no-brainer to spend the money to know, with the camera scope and everything, to know what you're buying in that house to save yourself from a lot of money and headache in the near future. And the last inspection we'll talk about that you may want to consider is a radon inspection. Now, here's the thing in Arizona, guys. If you're not from Arizona, or I should say specifically the valley, the desert here down in Phoenix, you are probably thinking, yeah, I want the radon inspection done because it's very prevalent in other parts of America. But in Phoenix, guys, radon isn't that big of a deal. In fact, most people who buy a home in Phoenix will not get a radon inspection. Now, we would never recommend a client to not get one. If they want to get one, we would highly encourage it because you never know. It's always better to be safe than sorry, and this will run you a couple $100s to get this done. But again, it's nothing like what it typically is in other parts of the country. Now, if you go to northern Arizona in the upper rim where the mountains are, in Flagstaff, Prescott, it is more common, so you probably are more apt to have a radon inspection in those areas of Arizona. But in the desert, in the Phoenix area, not that common. Now, the second group of closing costs are fees that you pay at closing. When you get to the closing table and you bring your check in with your down payment, you're gonna have some fees that you're gonna pay at that time. You'll know ahead of time because the title company will let you know what that amount's gonna be, so you bring the check in or wire the money, but you wanna check those fees to make sure it's what you and your lender agreed upon. The typical two fees a lender will charge down here in Arizona is gonna be a underwriting fee and a processing fee. Those fees will range anywhere from $1,000 to $1,500 each, and be on the lookout for that. Now, in an environment where interest rates are actually higher than lower, like they are right now, a lot of times you may potentially have a point. You may have points when it comes to lender fees to be able to figure out what interest rate you can best situate in when it comes to the pricing of the rate for your approval. And also grouped in these fees are going to be title and escrow fees. That's right, guys. In Arizona, we are an escrow state. We are a non-attorney state. So you don't pay attorney fees, nor do you have the access to an attorney that has to be on every single file. Now, if you want real estate attorney representation, you absolutely can get that. That is available. There are plenty of those in the state of Arizona, but you don't have to as part of the transaction like you do in many other states. So those fees typically are going to go as follows. You have an escrow fee, which is the fee that the buyer and seller both share. That's paid to the escrow company to be a third-party neutral facilitator of the transaction. And then you're going to have lender title insurance if you're on the buy side. If you're on the seller side, you're going to have what is called an owner's title insurance policy that they will pay. Now, the lender will require, if you're getting financing, that you have title insurance because they want to ensure their first position on the loan if anything ever goes south. If you're paying cash, you can elect not to have title insurance if you want, which will save you some money, but it potentially is always smart to have just in case. These fees will range. So let's say if you have $1 million house, you might be looking, or $1 million loan, I should say, you might be looking somewhere in the ballpark of $1,500 for the escrow fee, and somewhere in the ballpark of $4,500, somewhere in there, plus or minus, for the title insurance. So those are the fees you will incur when purchasing a house at closing. The last little bit of fees are called endorsements. These are small little fees that you have to pay, like a county recording fee and things of that nature, maybe an overnight courier fee, notary fee, that sort of thing if you use them. So those are the other small little fees that might be $25, $35, something in that ballpark. And last but not least, these aren't really fees because you have to pay them anyway, but these are property taxes. Let's talk really quick about how that works in Arizona, because in Arizona, property taxes are paid in arrears, meaning you will always be paying the previous 6 months for the payment that was due 6 months ago, if that makes sense. So then when you close on a property, the title company is going to actually prorate all the taxes that you still owe as a seller to the day it closes. So at the buyer, when you assume the property, you will start paying taxes from that day on, and you will not have the encumbrance of the previous property taxes that may not have been paid up to speed to that date of closing. So hopefully that makes a lot of sense. We'll walk you all through that. Now, when you do buy a house, you also may want to choose to have insurance. Now, I say that because you can also elect, if you're a cash buyer, maybe not to have insurance. I know several people who do that because insurance has gotten so expensive recently, and that's very risky, but to each their own. I would recommend it. Have insurance and get it on the house. And when you go to get that insurance, the insurance carrier may require, or the lender, for your escrow account where your taxes and insurance are held, they may require that to be paid a full year up front. So be on the lookout for that. That doesn't mean you are paying an additional year and getting nothing for it. You're just prepaying, so to speak, that full year. So that will look like a big hefty cost, but you're getting the benefit of that whole year of insurance. Whew, that is a lot of information. Hope your head is not spinning, but it's a lot of details that we're trying to give you on this video so you are fully informed when it's time to start house hunting for that next house here in Phoenix, Arizona. Question 4, in terms of the question we get the most often, is how do I know how much I'm qualified for? Well, this becomes a very, again, specific process where a lender will have a whole underwriting department that specifically looks at all your financials and your situation, and they determine what you're qualified for. However, actually how it works is a lot of these lenders have automated underwriting processes that up front the loan officer knows if you're going to qualify and for how much right there. And then the underwriter simply just verifies everything towards the end of the process. So they're going to look at things like debt to income ratio, how much debt you have compared to how much income you have. And hopefully the income is more than debt. If it's not, you probably won't be getting a loan. But typically, you're going to be at 50% debt to income ratio or lower to qualify for a loan. The next big thing is your FICO score. That's right, guys, your FICO score is huge. Take good care of it. FICO score can run between a score of 300 all up to 850 points. You typically have to have a FICO score above 620 points to start the process of getting a loan of some type. There are some exceptions where you might be able to drop down to 580 maybe, but typically 620 or higher is where it starts for a entity, a lender giving you a loan. And then of course it also matters on your income. Are you W-2'd or 1099 as an independent contractor, a business owner with a profit and loss statement? You're gonna have to supply that at a minimum for that. If you're W-2'd, congratulations, you already have a leg up when it comes to lenders because they love the steadiness of that W-2 check coming in every 2 weeks or every month or every week or however the frequency is that you get paid. And the fifth and final most popular question we get from people looking to buy for the first time is, should I buy a single family house or should I buy a townhouse or condo? This is a great question because condos and townhouses typically are more affordable than a single family house. They're less cheap and you have less maintenance potentially, and they are smaller and things of that nature, maybe less privacy, maybe not a yard, but this is the question we get quite often and it's a fantastic one. The question becomes, what's your personal situation like? What's your financial situation like? How much money are you making? And what's your long-term, what's your exit strategy for this property you want to buy? A lot of people we're starting to talk to now, they want to invest in real estate, which we absolutely love and highly, highly recommend. And we would love to help you put a plan together for that. But it's a great plan to be able to buy that first property, live in it, and then when you want to buy that next property, you hold it and use it as a rental property if you, of course, have the stomach for being a landlord. So if that's the case, you have to pay attention to your HOA dues for a townhouse or a condo. Now, single-family houses, a lot of them do have HOA dues as well, but they're typically not anywhere remotely close to how much they are for a condo building or a townhouse. And if you have high HOA dues, that can kill your cash flow if you're ever looking to potentially rent that out. So just be aware of what those are based upon what the market rents are in that area. But let's talk appreciation for a second. Overall, a single family house will appreciate faster than a condo or townhouse will given the same environment. So if you're looking for that equity play and growing equity in a property and building net worth, then your single family house will be your faster path. So maybe if you can stretch to buy that single family house the first time out of the gate, then I would go that path. On the flip side, if you're a working professional, maybe for your job, you travel a lot, you're flying in and out, the airport, the city you live in, then maybe the condo is more your lifestyle because it's far less maintenance without a backyard and a pool or landscaping to have to mess with. So these are all things to consider based upon your specific situation. But I can tell you now, it is very wise to get into the game of home ownership no matter what you do buy. So think about that. I have all kinds of stats I've done in the past on other videos. I'd be happy to have a conversation with you specifically. Call us at 480-660-5974 and check us out on our Instagram page right here at Kelly Cook Homes. We're putting out daily content for your education and enjoyment. Don't forget to call me